I think they're far more realistic, definitely. The previous seller forecasts from the IMF were, I think, too pessimistic and weren't fully taking into account the trade linkages, for instance, with Asia, which are obviously some of the key drivers of South African growth. We're still sitting around 3.2% for growth this year, including a 0.7% add-on from the World Cup for the whole year. So the IMF moving back in line. I think this would also buoy the sort of sentiment at the SARB. We know John Markets in particular likes looking and analysing the international situation and how that affects South Africa. So it should provide a slightly more positive backdrop for the SARB as well.
Of course, Theo, we did have the IMF warning that the credit conditions would remain tight in South Africa. We've had all of those job losses last year, close to 900,000, and also the rand at current levels starting to temper the growth we are seeing. And those retail sales last week, pretty disappointing, minus 1.5% for February.
Look, if you look at the forward rate agreements for the next 3 to 6 to 9 months, there's a more than 50% chance, according to the money market, that we'll get another 50 basis points cut on the 13th of May. In terms of the bank lending out credit, obviously the central bank can do little to force that, but as interest rates become lower, the serviceability of debts in theory would become easier. And I think the trend that we're seeing internationally, that slowly we're starting to see growth in the credit market, we need that as an integral part to get back on growth and to get the consumer back again. Obviously, we have also, as Peter was alluding to, we have the World Cup, which is a factor that will change South Africa and that will change retail sales. My view is that the growth numbers of 3.2 is a lot more realistic than numbers we've been seeing for the last 3 to 4 months. And I actually think that if we get the right countries moving into the latter phases of the World Cup, and with that I mean the countries where you can expect big spending tourism coming from, we might even see a bit more on the consumer spending than a lot of people is expecting.
Well, Peter, what is your view on a possible interest rate cuts, another interest rate cuts in South Africa, given that retail sales still under pressure, demand for credit not looking that fantastic, but this all coupled with the fact that growth is looking better and our manufacturing sector is also looking far better than what it was a year ago?
Well, I think another cut would, in my view, be a policy mistake. I think there was an argument at the last meeting around lowering the rate based on the sort of relative price impact that Eskom tariff hikes have on the consumer balance sheet, and one can argue around the effects on potential growth, that sort of thing that resulted from that. And that's sort of the line that SARB were trying to push at the time. But I think the market was also quite worried as well around the linkage that's been made between currency and rates, particularly by the doves on the MPC, I think. And they can do this more readily, I think, under the new mandate regime that we now have. I mean, having said that, I don't certainly rule out the possibility of another rate cut. I think I'd put a probability on that of about 40%. I think the MPC has shifted their forecast horizon, if you like, to be far more short-termist, and therefore they may well be weighed by, for instance, CPI dropping in the coming weeks to 5.3% by that weak retail sales number. But I don't think it was actually that weak. Overall, it was in line with our forecast. But I think we should also remember that the window is closing for SARB rate cuts in the sense that the next meeting after this one will be in July, which is just after the World Cup. And I think one of the big areas that people aren't talking about in South Africa is inflation during the World Cup could well jump by our estimates up to around 7.5%. It'd be very difficult for them to cut in that July meeting.
Of course, Peter, we are getting an inflation release next week. You just mentioned 5.3%. Is that where you expect CPI to register when we get next week's reading? And I think we're also expecting credit extension numbers. Do you expect any movement on that side?
Yeah, so I mean, we see inflation dropping in year-on-year terms, but I think some of the underlying pressures are still definitely there within the index. I mean, the headline number is being driven by food in particular at the moment, with pressures coming off there. But some of the more wage-related, electricity, sort of pass-through related items still showing some underlying inflationary pressure there. But also, I think you mentioned credit extensions. It's an important number. We have seen the bottoming out in credit conditions. And I think we are now seeing month-on-month growth of about 0.5, 0.6% in both household and corporate numbers, which can support a recovery through this year.
Peter, there's also news that the inflation basket is going to be reweighted on a 3-month period, or 3-year period, as opposed to, I think, the initial 5 years that they used to weight it on. What kind of influence is that going to have on inflation? Do you think it's going to be positive?
Well, it's hopefully hard to know what exactly they're going to do to affect the headline index, but I think keeping it up to date, particularly in a rapidly changing society like South Africa, is not a bad thing. That said, there were obviously some issues last time, particularly around the reweighting of PPI that happened 2 or so years ago. So I mean, as long as the market and analysts can be confident in the methodology and the changes that are going to occur, then I think it's not necessarily a bad thing at all.
Theo, currency misalignments, that's alluded to in the IMF reports, and of course we know that lots of the emerging market currencies, particularly those linked to commodities such as ours and the Brazilian real, have been strengthening. The IMF says this is a threat to the pace of recovery in these countries. Do you think it's something we have to live with, though? And of course, when we spoke to Peter a couple of weeks ago, we were talking about the rand perhaps weakening potentially after the World Cup. Do you think that would bring us back into line?
Look, I think if the World Cup obviously is a big factor that's very difficult to model, and we don't know exactly how that's going to work out in any model in terms of what's the impact of that going to be on these economic variables. However, if I look at the South African rand where it is now, it is too strong for our local economy. At these levels, our mining sector and our manufacturing sector, or let's rather say the sectors that employ big numbers of people, are under pressure. We need a weaker currency in order for those sectors to actually make proper money. And I also think from a fair value point of view, I think the fair value is probably closer to 8 Rand, or let's say 8 Rand 50 than the current levels. Now, the point is, why is it so strong? I think this is a lot to do with the fact that in the capital intensive, or let's say the first world, the developed countries, interest rates are at very low levels, and the official rates are at the lowest it's been for 300-400 years, depending how you look at it. Now that obviously creates some search for yield, but also could create allocation of capital in terms of a non-normal kind of allocation. I think our country is a beneficiary of that in terms of capital inflow, but on the counter side of that is we get a currency that I believe is slightly too strong for what's good for the South African economy.
Peter, looking at this strong rand, we have weakened over the last few sessions. We know that risk aversion globally is starting to come to the fore, but we've seen quite a bit of money coming through into the bond market. We've seen around 9 billion rand for April coming into the bond market, which kind of counteracts the fact that we haven't seen so much coming through into the equity front. We know that you've pegged the rand at around 9.50 to the dollar by the end of the year, but just looking at the current weakness that we're seeing, do you expect more strength to come to the fore going forward before we weaken again at the end of the year?
I think one of the big ideas that the market is trying to grapple with at the moment is around FX policy and what the SARB is going to do on this front, National Treasury, and also more widely people like the ANC, what their input's going to be on currency policy. And I think a lot of the inflows, for instance, are sort of priced into the FX market at the moment. Those flows are expected to continue a little more. Having said that, we are seeing quite a number of London bond holder names go underweight South African bonds now slowly. So I think that some of those inflows should start to slow a little, and we can get basically the pressures can allow us to remain broadly where we are through to the end of the World Cup. I think it's important to remember the World Cup is not so much a flow issue as a sentiment issue. I think, for instance, one hedge fund could offset in a few days the net inflows that will occur by tourists on the back of the World Cup. So it's more a sentiment thing for markets and an unwillingness for people to necessarily leverage money in particular to go short rand in any particularly large sides before the World Cup.
Peter, and just looking at sentiment issues, though, previously the currency would have carried a certain amount of political risk, and we have seen lots of controversy surrounding certain members within the African National Congress and the ANC Youth League. That has been making the press overseas. Doesn't seem to have any impact on the currency, though, so this political risk has moved away from the rand at this point.
I think what we have to remember when a lot of investors look into South Africa is that there is obviously an allocation of money into emerging markets, and within that, South Africa has a certain weighting within indices that people have to track. So a lot of this money is put in South Africa by default. So that's why some of these stories don't necessarily see an impact, if you like, straight away. But for instance, the Julius Malema story is starting to weigh on people's minds. A lot of investors I've talked to, both in London and in Asia, are starting to pay more attention to what this guy is up to. I mean, I still advise people to ignore what he's up to on a day-to-day basis, but I think we have to remember this guy is probably a career politician. He's going to have a long-run impact on South Africa, and this is why I think the ANC actually missed an opportunity this week in terms of trying to bring him in line.